All right, let's jump right in. For decades, trying to figure out what the biggest players on Wall Street are doing in real time has been this huge, multi-billion-dollar guessing game. But what if I told you the clue to their daily moves was hiding in plain sight this whole time, based on one ridiculously simple principle?
So first, you got to understand the scale we're talking about. 80%. That's roughly how much of the US stock market is actually held by the big guys, the huge institutional investors. We're talking massive pension funds, giant investment firms, the real heavy hitters. And look, to put it simply, these guys are the market. When they decide to buy, the market tends to go up. When they sell, it tends to go down. They're the ones making the waves, and pretty much everyone else is just along for the ride. Which brings us to the trillion-dollar question. What are they doing right now? Because let's be real, knowing what they did 3 months ago, that's ancient history. Knowing what they're doing today, well, that's the holy grail. And some fascinating new research suggests we might have finally found it. Okay, so let's get into Wall Street's big black box. You see, for the longest time, trying to track these institutions in real time was like trying to solve a puzzle in a pitch black room. The tools we had just weren't cutting it. I mean, the old ways are just totally obsolete. You've got these quarterly filings. By the time we see them, they're up to 135 days old. That's an eternity. And what about those smart algorithms designed to spot big trades? Nope. The institutions figured that out. They now slice and dice their huge orders into thousands of tiny, untraceable pieces. It's like a ghost in the machine. But then, a groundbreaking research paper comes along with a new idea. And it's not some super complex algorithm. No, it's based on this one, almost beautifully simple clue. A clue that, it turns out, was right there under our noses the whole time. And here it is. You can only lend what you own. That's it. That's the whole idea in a nutshell. And it changes everything. Think about it. You can't offer up a stock for someone else to borrow unless you actually have it in your portfolio. So if we can see what they're putting up for loan, we can see what they own. It's that simple. And that brings us to this key term, lendable equity. The easiest way to think about it is like a giant library of stocks. The big institutions, they take all the stocks they own and they put a bunch of them on the library shelves, making them available for others to borrow. And of course, they collect a nice little fee for it. It's this library inventory, which changes every single day. That's the key we've been looking for. So let's just walk through the logic. It's pretty straightforward. 1. Institutions own a massive inventory of stocks. 2. They make some of that lendable to earn extra cash. And here's the kicker. 3. That lendable supply gets updated daily, which means 4. A change in that supply is a huge signal of a change in ownership. If 1 million shares of a stock suddenly disappear from the for loan pile, it's a pretty darn good bet a big institution just sold those shares. All right, so the theory sounds solid, right? But the real question is, does it actually work in practice? Let's put this clue to the test and see how it stacks up against the old ways. And wow, the results are pretty stunning. This chart here shows something called R-squared. Just think of it as an accuracy score. The old ways, like trying to track trade sizes, get a pathetic 0.4. Even using fancy data on actual trades only gets you to 5. But this new clue, tracking lendable equity, it scores a 17.7. I mean, this isn't just a little bit better. It's a total game changer. It's not even in the same ballpark. Really, the best analogy is this. It's like we spent decades trying to figure out what's happening by looking at a blurry, out-of-focus photograph that's 3 months old. And now suddenly someone's handed us a 4K high-definition live video feed. That's the difference we're talking about. Okay, so we've got this incredible new window into the market. The big question is, what can we see now that we couldn't see before? Let's peel back the curtain on 3 market secrets that this new data reveals. Okay, secret number 1 is what we can call the earnings announcement dance. It's this really consistent pattern. The data clearly shows that institutions sell their positions in the days before a company announces its earnings, to lower their risk, and then bam, as soon as the announcement is over, they buy right back in. This predictable pattern of selling then buying actually helps explain that earnings announcement premium that people have talked about for years. All right, secret number 2 is all about price pressure, and it's a bit of a head-scratcher. You might think, great, I can see what the big guys are doing, I'll just copy them, right? Well, maybe not. It's not that simple.
It turns out, if you just blindly copy their biggest moves every day, you'd actually end up losing money, about 22 basis points over the next month. So why is that? It's because these trades are so huge, they create their own temporary ripple in the market. Their buying artificially pushes the price up, and their selling artificially pushes it down. And then, over the next few weeks, the price just kind of snaps back to where it should have been.
And that brings us to secret number 3, which, for my money, is the most fascinating one. It helps us crack a really famous market puzzle, the momentum paradox. In other words, when and why do hot stocks stay hot? This is so cool. The research found that momentum, the idea that winning stocks keep on winning, it really only works when the big institutions are doing the opposite of the price trend. So check this out. If a stock's price is going up and the institutions are buying it too, then everybody agrees. The information gets priced in super fast and the momentum just fizzles out. But if the price is going up and the institutions are actually selling that stock, the market gets all confused, it underreacts, and that's when the momentum keeps going. It's almost like the market needs the big guy's stamp of approval before it fully believes a price move is for real. So let's step back for a second. We've been peering through this new high-definition window into Wall Street. What's the big takeaway here? What does this all really mean?
Okay, so let's do a quick recap. We learned that this one simple clue, lendable shares, gives us an incredible daily peek into what the market's biggest players are up to. We saw how they do this little dance around earnings announcements. We saw how their giant trades can temporarily push prices around. And we saw that they are the absolute key to understanding market momentum.
And all of this leaves us with one last, kind of provocative thought to chew on. For years and years, people have talked about skill in the market. But now that we can see the footprints of these giants so much more clearly, you really have to wonder how much of what we call skill is just being really, really good at following those footprints.